Breakout strategies, they look so promising until they destroy your portfolio. As you can see on my screen here, you spot a breakout, jump into the trade and think you're about to make a fortune, but then the price reverses, leaving you wondering what just happened. False breakouts are the silent killers of trading success, but here's the truth. They are completely avoidable if you know what to look for. I've discovered a technique that actually works. It's simple, effective, and earned me over £900 in one day alone, making it perfect for anyone trying to master breakout trading. So let's head over to the charts and understand how to avoid these false breakouts. If you're at this video, then you probably already know what breakouts are. Now, breakout trading could be identified in many ways. The traditional way is if you've got a ranging market goes up, down, in a range, and it could either, right, let's take the middle. It could break up and go that way, or it can break down and go that way. Now, the key thing here is, you got to be clear is, are you trying to get the top of the breakout? And if so, why? Does it make you a better trader? Do you get a trophy for it? Do you get rewarded? Is everyone going to stand there and say, hey, you're amazing? I'm going to make this video short and quick and get straight to the point, because the simple technique is wait for a confirmation and piggyback on the continuation of the breakout. Let me say it again. Wait for the market to do its thing. Once it's confirmed its breakout, confirmed it, piggyback on the continuation of the move. Why do you need to get the beginning of the breakout? Just answer the question. Put it in the comments. I don't know. I used to be like that. I wanted to say, hey, I need to make sure I get right to the top so I can maximize my profits. Again, it can vary on time frames. It can vary on what your objective is. But if we want to avoid the false breakouts, just look at this. If the market is going up, down, up, down, up, down, and this is, resistance, this is support, and we're seeing the market move, the simple technique that still works to this day is if the market's going to break up, it comes back and retests. At this moment here, we're looking to catch the next phase one. Now, you're probably thinking, oh, Suk, it can't be that simple. Let me explain in more detail. Even if it breaks down lower and comes back and retests, that's the pattern we're trying to do. Now, if you watch one of my previous videos, Master Price Action, simply, market has reversal areas. Now, this could be identified as a reversal structure. Let me explain. If the market's going up and then we take out that swing, that's made a reversal structure and the market could go down. If the market's going down and the market breaks that swing, that means the market could go up. It's the same thing here. We've broken this swing. Swing could be known as a higher high. This could be known as just a price point move. This could be known as the market's gone up there and now it's gone back there. There's complicated names. Many traders out there or other educators have made fantastic names for them. Me, simply, market's gone up. No, market's gone down. Market's gone down. Market's gone up. That's what it's essentially doing, isn't it? A market is a place of buyers and sellers. There's no fancy word between buyers and sellers, is there? So, the false breakout, or how to avoid it, is the basic way is to start with a range. So you've got a range like this, and the market goes sideways like that. And again, people are like, well, do you use the wicks? Do you use the bars? Do you use the price action? Doesn't matter, right? What we're looking for is even if the market goes up, we're trying to piggyback that next move. If the market goes down, we're trying to piggyback that next move. This should create a reversal area in here, and this should create a reversal structure, also known as a retest. Now, regardless if you're using patterns like this, pennants or triangles, it's the same thing. All we're simply doing is looking for the re-entry. So how to avoid the false breakout is the re-entry. The re-entry is where you're going to spend a lot of your time. So once the market has broken out, let's say here, and it's gone up, at this point here, from here, you're going to try to speculate where this stops. You don't need to trade it, and where the market could pull back. So at this point here, you could use fibs, you can use things like fibs, you could use price action, you could use pivots, you could drop down to lower time frames. But at this point here is where you are looking to re-enter. Now that's where you're going to have to put your attention at this point. Now the market could go back here. So some people might be very strict and they say, well, if the market comes back and retests this exact area, which was once a support and now becomes a resistance, only then I would trigger it. That is a method. Now, at that point, some traders might watch my last video and might put a engulfing pattern here. They might use Fibonacci of this area just to make sure they can find areas to put their stop losses. They might use moving averages as extra confirmation. The simple structure here is just let the market pull back and get a price action of a retest where the support once becomes a resistance, where the resistance once becomes a support. After all these years, I still get confused. See? Doesn't matter. I could edit it out, but it's okay because these are just methods and structures. Just because you understand it carefully or perfectly doesn't mean you're a better trader. Think about it. The key thing here is you need to have a direction. Once you have a direction, breakouts are very easy to not get wrong. Let me explain. So let's say the bigger picture is you want to be a buyer, right? Let's just say that. And you're at this point here. And in here, you might get a lot of noise. Okay, it goes up, down, and gets a lot of noise. Now, once the market goes up, we want to try piggyback on that. This is exactly what I've been saying in all my other videos, right? If you break that down to what you think can happen next in the week ahead on the higher time frame, it's very easy that once the higher time frame has done it, and you put all your attention in organizing for the next piggy bank move, whether it's going down or up, right? This is where you put your focus. And in that focus, that's where you are going to organize yourself. You filter out what's not worth trading. You focus on what's worth trading and testing that forward. As long as you get the direction right, don't worry about that perfect entry. There will be a strategy to this. Any strategy can essentially work if you get that direction right. It's your mindset thinking it has to work on a perfect level. If you're doing any sort of trading with moving averages, right, the trade comes in the middle of the trend or in the middle of the move, because the word is an average, and we're going to do another video on that soon. But let that sink in. So to avoid the breakouts, whether you're doing wedges, okay, two of my favorite, right, where it might look like a rising wedge or you get a falling wedge, okay? And if you're at a resistance, market might go like this, and you might get a rising wedge. Again, everybody wants to trade that breakout. Let the market take out that swing and piggy bank in here. Do you have to get in here when it's easier just to get in here? It's the same thing as the market goes down, right? This could make a falling wedge like this. I'm just saying, or a channel down. Let the market break that swing and piggy bank into that move up. Make the money in the middle of the trend. That's the easiest way to avoid getting those traps. Let the confirmation happen. So if you want a step-by-step video showing you in more detail how I choose my favorite candlestick pattern, I put together a video that is perfect for you, and you can watch it here.